What's up everyone, my name's Robbie, this is Robbie and Manila, and today we're talking about my calls for the best sectors of 2022. Now if you're a regular watcher of my channel, you might know that I made a video like this back in 2020 where I made some calls about the best sectors of 2021. Of my sector picks, I was correct about 7 of my picks and incorrect about 4 of them, so actually I was really happy with my results. Now if you watch my last video, you'll see the reveal of how I did against the S&P 500. And you'll see the really stupid mistake I made. So watch that video if you want to. I will link it in the description below. If you're not familiar with the stock market and the different sectors of the stock market, basically there are 11 different sectors, and some people decide to try to overweight certain sectors because they think it'll do better than the overall stock market or the S&P 500 index. You can call this tactical allocation if you want to, where you try to tactically pick the correct sectors to try to beat the market, but basically if we take a look here, we can see that this gray box is how the S&P 500 performed, let's say in 2021, and it had a 28.7% return. Now these 4 different sectors outperformed the S&P 500. So if you had only invested in, let's say, these 4 different sectors, you would have done better than the index. This is information technology at a 34.5% return, financials, real estate, and energy. Now, if you had invested, for example, in just, let's say, utilities, you would have underperformed the S&P 500. But as you can see, the different sectors don't always outperform, they don't always underperform. That's why sometimes I like to try to pick the sectors I think will do better. You can see utilities, for example, did worse in 2021, but look at 2018, where it was the second best sector. And if you go back to 2011, utilities was the best sector with a 19.9% return, where the S&P 500 only did 2.1%. So that's basically the reasoning behind this whole video. Some people like to pick the sectors and try to create a portfolio similar to the S&P 500 that's overweighted in certain sectors, underweighted in other sectors. So before I tell you the exact sectors I think will do best this year and the ETFs that you can use to invest in those sectors, let me tell you what I think is going to kind of happen this year, and basically it's the framework of most of my decisions. So I think 2 really big things are going to happen this year that are going to drive what's going on in the market, and so one of those things is that there's going to be some inflation. And if I'm right, the fact that there will be inflation that's higher than we're used to is going to have different effects on different sectors. And so if we take a look at this chart from Hartford Funds, this is showing PE ratios during different times of inflation. And what you'll see is that there's not really a correlation between inflation and PE ratios as long as inflation is under about 4%. But once inflation goes over 4%, PE ratios tend to contract. And as you'll see here, there wasn't a time period where there was a PE ratio of the general market higher than 20 while there was inflation of higher than 4%. So that might kind of be the magic number. If inflation is higher than 4% in 2022, we might be looking at a very contracted PE ratio for the general market. But the thing is, that doesn't mean that all of the sectors in the stock market will have contracting PE ratios or will do worse. There are certain sectors that actually might do better in inflation. So what this chart is showing us from Fidelity is sector correlation during different time periods of inflation and how those different sectors performed. So for example, this big bar here was 2003 to 2008. So all of these green bars are that time period. This is the energy sector, and you'll see different bars for different time periods. For example, 1966 to 1980 is this blue one. The light blue one is 1942 to 1951. And so what you'll see here is that there is a higher correlation between energy having an outperformance and materials having an outperformance in times of higher inflation. This next chart that's also from Hartford Funds kind of shows us something similar. So what we're looking at first on the y-axis is basically the level of outperformance versus inflation. So for example, if the S&P 500 returned 10% and you returned 15%, that's 5 percentage points more than the S&P 500. So this would be a 5 here. And then down on the x-axis is basically how many times it happened, the percentage of time it happened. So the more probable it is to happen, the further over it'll be. So as you can see, energy here has 70% of the time when inflation was higher than 3%, energy ended up outperforming the market by almost 10%. And so this upper right quadrant is kind of the area that you want to be situated in this. And as you'll see, equity REITs are also in here, consumer staples, utilities, and healthcare. But the thing is, consumer staples didn't really outperform that much. Of course, it didn't underperform, so that's good, but it didn't really outperform by large margins. So these are just things to kind of take into consideration as we move on. So yes, I do think inflation will be present in 2022, and some of my sector picks are going to be based on that. I also think there will be some interest rate hikes this year, and so some of my picks will actually also be based on that. So let's get into this and go over my sector picks for 2022. All right, let's get started. But first, I do have a question for you. So in the comments below, leave a little comment. Let me know what you think about this idea. Do you want to see a video of my calls for what's going to happen this year? So like what's going to happen with interest rates, what's going to happen with inflation, maybe what the S&P 500 closes at, just like some fun stuff, not too serious. But would you be interested in a video about that? If so, let me know in the comments below. Also, if you want to support my channel, I have affiliate links to different things down there, so you can always click on one of those if you want to start like an M1 Finance account or a Morningstar account or something like that. Just take a look below. Some of those affiliate links, it supports my channel, so thanks in advance for that. So here's the big reveal. These are my top sector picks for 2022. So let's start with the overweight picks that I have here, and the first thing you'll see is that I have the ticker symbols here of the different ETFs that I would use for this. Now, I have videos on every single one of these sectors and why I think these specific ETFs are the best in each of those sectors to invest in. So I'll link the series below, which shows 11 different videos on all of the different sectors to try to figure out the best sector ETFs for each sector. The thing I wanted to make sure that you see here is, so first I have financials is one of my top picks. Now, I picked RYF as the ETF here, which is an equally weighted ETF. And if you go watch my best financial sector ETF video, you'll see that I picked two different ETFs. And RYF is one of the ones that's equally weighted. So next we have the current price of 67.55 for this ETF, the price when it's added, which of course it's just added. And there hasn't been any gains yet because I just added this. Now this spreadsheet there's going to be a link below that you can take a look at this spreadsheet whenever you want to. So the percent allocation I have in this is 20% of the portfolio would be in financials. This is quite a bit higher than the S&P 500. So the S&P 500 has 10.7% of the index in financials. So I'm going 9.3 percentage points more than what the S&P 500 has. So if I'm right, it'll be a very good call, and if I'm wrong, it'll be a bad call. It'll go the bad way if I get it wrong. So the S&P 500 price is here. The price when it's added, of course, there's been no gain or anything like that. And then at the end here, you're going to see like how my portfolio actually performed. This theoretical portfolio of these sector ETFs performed versus the S&P 500. So this is where you'll look to see if I've done better or worse than the index. So next we have XLE. So I went with the energy sector on this one. I went with 12% of allocation. The normal S&P 500 has 2.7% in energy. I'm going way over on this one as well, 9.3 percentage points higher than the S&P 500. So again, if I'm right on this, pat on the back. If I'm wrong about this, I look like an idiot. And then I have VDC here as consumer staples. 10% of the portfolio in consumer staples. That's compared to 5.9% of the S&P 500. That's in consumer staples. That's 4.1% higher than the S&P 500 index. And then moving on to the different equal weight positions. So FHLC, so that's healthcare, 13.3% is my sector. And then of course 13.3% is the S&P 500. These are all equally weighted, so they're all going to be the same as the S&P 500. So XLRE, real estate at 2.8%, RGI, which is industrials, at 7.8%, RTM, which is materials, at 2.6%. Then we have the underweight sectors, and so we have communications, so FCOM is the ETF, 3.5% I have in this, compared to 10.2%, so that's 6.7% under the normal S&P 500 index. VGT, so that's a tech sector ETF, and you might be thinking to yourself, hey man, that's pretty ballsy. Like, everyone loves tech, and yeah, I'm gonna go against the crowd on this one, people. I'm contrarian on this. I'm gonna contrarian. So I'm going against tech, but you might want to just take a look here first before you call me crazy. I still have 21% of this allocated into tech, so it's not like I went to 0% tech. It's still the largest position in the portfolio, but instead of 29.2% of the S&P 500, I have 21%. So I am underweighting it, but I still have quite a bit in it. VPU, which is utilities, I actually went with 0 because utilities tends to underperform unless it's kind of a bear market or there's some problems. I don't think that's going to necessarily happen this year. But again, if you want to see my calls for the year, let me know in the comments below and you'll see what I think was going to happen this year. Next, I have FDIS, the Consumer Discretionary ETF, 7% of my portfolio. 12.5% of this is usually in the S&P 500, so I'm actually underweighting the S&P 500 by 5.5 percentage points. So those are the different calls. I just want to go over now and kind of show you what's going on with each of the sectors real quick. Now, I don't want this video to drag on too long, but I'm going to try to go through this quickly. So basically, financials. I have RYF, the Invesco S&P 500 equally weighted financial ETF. Why did I go equally weighted? So by going with RYF, we're going to have more exposure to the smaller companies inside the financial sector. The financial sector includes things like the banking industry, insurance industry. So for example, like you're going to get more regional banks in this probably than you would if you just had a regular market cap weighted ETF for the financial sector, because you're going to get like giant JP Morgan in there, you're going to get Bank of America, you're going to get these bigger companies that are going to have higher weightings. This way we get more exposure to the broad index or sector, and I think that's actually going to be good because I think those smaller companies are going to do better than the larger companies this year. That's why I'm going with this one. So looking here first, we have the PE ratio of XLF and RYF. So the PE ratio of XLF is this green one, the darker blue one is RYF, and then we have the S&P 500 via SPY. As you can see, the PE ratios for both of these different sector ETFs, RYF and XLF, which are both the financial sector ETFs, are probably actually a little bit under their historical PE ratio levels. So I think that's a good thing. Maybe it could be good, especially if interest rates go up. And if we look at the price to book ratios of these three, we can also see that very similar for RYF and the price to book ratio of XLF being right here, which is very much average to what's been going on over the past few years. But again, you can see the S&P 500 is way higher than the average over the past few years. Next, we have energy. So I have XLF as the energy sector select spider fund as the ETF that I would pick, and then the historical price to earnings ratio of XLE. So the thing is here, there have been times where the energy sector has not even had an average PE ratio because earnings haven't even been positive. So this looks kind of weird, but you'll see that it's really around the PE ratio of the S&P 500, but price to book is probably better to look at for this one. So a really low price to book comparatively with the S&P 500, and actually a bit below the average over the past few years. So looking pretty good there. With consumer staples, we have VDC, which is Vanguard's consumer staples ETF. For the PE ratio of this, it's very similar to the S&P 500, and for the price to book, it's also getting really close to the S&P 500. So, consumer staples, one of the things about this one is I think it does tend to potentially do well during inflationary times, basically because these are consumer staples and hopefully they have pricing power, so the companies are able to increase prices of their products and there's still demand for these things. So I'm overweight consumer staples. Next, we have healthcare, which I am equal weight. So FHLC is the ETF on this one, Fidelity MSCI Healthcare Index ETF. We have a price to earnings ratio for FHLC, very much in line with the S&P 500. Price to book is really pretty close, just a little bit above the S&P 500's average. For real estate, I have the XLRE Real Estate Select Sector Spider Fund. That's the one I picked. It does have kind of a high PE ratio, and price to book value is not too bad. Next up, we have industrials. RGI is what I've chosen, the Invesco S&P 500 equal weight industrials. Industrials are really close on the price to earnings area, but they are actually quite a bit higher than their average over the past few years in the price to book. Also really close to S&P 500, again, a little bit higher than the average over the past few years. So equally weight industrials. We have materials here. RTM is what I chose for this one. Invesco S&P 500 equal weight materials ETF. In terms of what's going on price to earnings, actually, they've definitely declined in the price to earnings. Average is closer to maybe what it's been over the past maybe 3 years. Price to book also is down, so potential for maybe expansion in price to book and price to earnings multiples here. Next, we have the communication services. We have FCOM, which is the Fidelity MSCI Communication Services Index ETF for FCOM. A bit lower on the PE ratio scale than the S&P 500. Probably in a bit better level now than it was a few months ago. And then price to book ratio here also come down quite a bit. So looking better here, but still not a big fan of what's going on right now in communication services. Moving on to technology, you might think I'm crazy for going underweight on technology. Look, there are times where technology is going to have to underperform the market. I mean, it's been a while, it's outperformed for many years, but there has to be times when this specific sector doesn't do the best. It's completely natural, and I think this might be the year that it happens. Last year, I thought it would be the year that it happens. This year, I think it's going to happen. We've already seen a lot of tech really getting pummeled, basically, so we'll see what happens. Should be interesting. VGT, Vanguard Information Technology ETF, is the best tech sector ETF. If we take a look at the PE ratio, of course, it's higher than the S&P 500. It's up in the over 30 area. If we take a look at the price to book value, very high, much higher than average over the past few years. Again, I don't think that it should be this high. I think that there's potential for this sector to probably be a bit flat for the year. Next, we have utilities. So VPU, Vanguard Utilities ETF, is the one I would use. Of course, I said I'm not allocating money into this ETF, but taking a look at utilities, it's pretty high. Price to book at least is a bit low. Utilities tend to do well during bear markets or times when there are recessions, things like that. So I think, I'm not really going to go for a utility company right now. They do pay good dividends. Next, we have consumer discretionary. For this, I have FDIS, the Fidelity MSCI Consumer Discretionary ETF. Here's the thing with this one. So consumer discretionary, this ETF in particularly, is very highly concentrated in two stocks, Amazon and Tesla. Now, you probably have your own views on those two companies. I particularly think that they're probably overvalued. I think that they should probably come down a bit from where they are. One of those I think should be a lot lower than where it is, but I do think that at this point I do not want to be in the consumer discretionary sector with those two stocks weighing so highly on that ETF. And in general, I don't think consumer discretionary in inflationary times may even be the best place to be. So for the price to earnings ratio of this one, it's it's close to the S&P 500, just a bit over it, a little bit higher than average, but as you can see, it's come down quite a bit. Then you have the price to book ratio historically is quite a bit higher than what's the price to book ratio. So I don't love what's going on here. I think it's pretty high for a price to book ratio view, so I don't really love this sector. So anyway, that's all we have for this video. Please, if you like this video, hit that like button, subscribe if you want to see future content kind of like this video. And if you do want to, see a video about my calls for the 2022, things like interest rates, what the S&P 500 might close at, let me know in the comments below. I'd love to hear from you. And before you go, I do have another video. It's coming up. It's on the end screen. You should probably all just click that thing. Just click it. Click it right now.